This year, the stock market has had a strong run with many investors seeing gains in their stock portfolios. But what if some of your investments didn't perform as well? Here's the good news. Even if you've experienced losses, you can use them strategically to reduce your tax bill. Whether you're planning for this year or preparing for the future, understanding stock loss harvesting strategies can help you offset gains, reduce your taxable income, and keep more of your money in your pocket. In this video, I'll break down the essentials of stock loss harvesting, including how it works, how to navigate the IRS's wash sale rule, and how to make the most of your investments even when they don't go as planned. Whether you've had a winning year or are looking to learn strategies for the next one, stick around. These tips could save you big come tax time. Hi everyone, my name's Noel Lorenzana, and I'm a CPA dedicated to helping you navigate the often confusing world of taxes and finance. Let's start with the basics. What exactly is stock loss harvesting? Simply put, stock loss harvesting is a tax strategy that allows you to turn losses from underperforming investments into a way to save money on your taxes. Even if some of your investments didn't work out as planned, they can still help offset gains from winning investments, or even reduce your ordinary taxable income. Here's how it works. When you sell a stock investment at a loss, it becomes a realized loss in the eyes of the IRS. You can then use those losses to offset realized gains from other investments, dollar for dollar. This helps to reduce or even eliminate the taxes owed on your profits. Now, if your stock losses exceed your gains, you can apply up to $3,000 of the excess losses to reduce your taxable income for the year. If you're in a higher tax bracket, this can be especially valuable, and any remaining losses can be carried forward into the future. Let's go over an example. Imagine you sold some Tesla stock earlier in the year and took a $10,000 loss. Later in the year, you made $8,000 in profit by selling Nvidia stock. By using stock loss harvesting, you can offset the $8,000 gain entirely with a $10,000 loss. That leaves you with $2,000 in remaining losses. You can then use $2,000 of that loss to reduce your regular taxable income. And if there's still more remaining, you can carry it forward into next year. Pretty cool, right? Whether you're reviewing your portfolio for this year or preparing for future tax years, stock loss harvesting is a strategy every investor should understand. Now, before you start selling your underperforming stocks to harvest losses, there's an important rule you need to understand, and that is the IRS wash sale rule. This rule is designed to prevent investors from claiming artificial losses on their taxes. Here's how it works. If you sell a stock or option at a loss, then buy the same or substantially identical investment within 30 days before or after the sale, the IRS will disallow that loss for tax purposes. This essentially creates a 61-day window to keep in mind. The date of the sale plus 30 days before and 30 days after. The IRS implemented this rule to prevent people from gaming the system. Without it, an investor could sell a stock at a loss, claim the loss on their taxes, and immediately buy back the same stock, keeping their investment while still taking the tax benefit. The wash sale rule ensures that only legitimate losses can be deducted. Here's the good news though. If you do trigger the wash sale rule, your loss isn't gone forever, it's just deferred, meaning the amount of the disallowed loss is added to the cost basis of the new investment. This adjustment ensures that you'll eventually claim the loss when you sell the replacement investment, so just not immediately. For example, let's say you sell 100 shares of Disney for $100 each, resulting in a $5,000 loss. Then within 30 days, you buy another 100 shares of Disney for, say, $90 per share. The $5,000 loss is disallowed by the wash sale rule, but it's added to the cost basis of your new purchase. Now, the cost basis of your new Disney shares is now $14,000 instead of $9,000. The $5,000 disallowed loss is added to the new cost basis. So when you eventually sell the new shares, that wash sale deferred loss will be accounted for in that sale. Does that make sense? Let me know in the comments if it doesn't. To avoid the hassle of triggering the wash sale rule, here are two simple strategies. Number one, wait 31 days before rebuying. If you sell a stock at a loss, Wait at least 31 days before buying it back again. Number 2, invest in similar but not identical assets. If you want to stay invested in the same sector, consider purchasing a different stock that's similar but not the same, or an ETF that's not considered substantially identical by the IRS. For example, instead of rebuying Tesla stock, maybe you could invest in an electric vehicle ETF. Your brokerage company will typically track wash sales and report them on your 1099 at year end, but it's always a good idea to double check their calculations to ensure accuracy. By performing and planning for the wash sale rule, you can make stop loss harvesting work for you without unexpected surprises. And here's a bonus tip for crypto investors. The wash sale rule does not currently apply to cryptocurrencies like Bitcoin or Ethereum. Why not? Well, the IRS treats crypto as property, not securities, which creates a unique loophole for crypto traders. This means you can sell a cryptocurrency at a loss and repurchase it immediately without triggering the wash sale rule. However, keep in mind that this could change in the future. If you're actively trading crypto, make sure you keep detailed records and stay up to date on any regulatory changes. Accurate record keeping is essential for stop loss harvesting. Your brokerage company will usually provide a detailed 1099 form that includes realized gains, losses, and wash sale adjustments. However, it's always wise to double check the reporting for errors. It happens. If you use tax software like TurboTax, import your brokerage data and verify the calculations. For more complex situations, working with a tax pro can help you avoid mistakes and maximize your deductions. Next, let's bring it all together with a few key takeaways and action steps to help you implement these strategies effectively. Number 1, review your portfolio. Take a close look at your investments, identify any underperforming stocks, mutual funds, or ETFs that you could sell at a loss. Be strategic about which assets to sell, considering how they fit into your broader financial goals. Number 2, be aware of deadlines. If you're watching this before December 31, remember that you need to complete your trades by then to take advantage of stop loss harvesting for this tax year. For viewers catching this after year end, don't worry, these strategies will still apply for future tax planning. Use this as a learning opportunity to prepare early for next year. 3, understand the wash sale rule. Avoid triggering the IRS wash sale rule by carefully timing your trades. Wait at least 31 days before rebuying the same or substantially identical securities, or consider alternatives like ETFs or similar investments to stay in the market without breaking the rule. 4, carry forward unused losses. If your losses exceed your gains and the $3,000 annual limit for offsetting ordinary income, you can carry forward any unused losses into future tax years. This can provide ongoing benefits, especially if you anticipate significant future gains. 5, consult a tax professional. While tax software programs can handle the basics of stop loss harvesting and wash sale rules, complex situations often require expert guidance. A CPA or tax professional can help you optimize your strategy, minimize errors, and maximize your savings. Stop loss harvesting isn't just a way to soften the blow of underperforming investments, it's a proactive financial strategy that can enhance your overall tax efficiency. If you found this video helpful, please give it a thumbs up and share with anyone who could benefit. And if you're not already subscribed, hit that subscribe button for more practical tips on taxes and finances and smart investing strategies. Have a question about stop loss harvesting, the wash sale rule, or anything else I covered today? Leave a comment below. I'd love to hear from you and help if I can. Thank you for watching, and I'll see you in another video.